Hey, before we get started, I want to talk to you a little bit about our theme for this quarter, growing and protecting your portfolio. We're excited about various topics centered around this, but it really comes down to three concepts that will help you grow and protect your portfolio. You can find a PDF on our website about this. Go to wiserinvestor.com, scroll down to the bottom, enter your email address, and you'll get the PDF titled 3 Ways to Grow and Protect Your Portfolio. Thanks for listening. Welcome to a Wiser Retirement Podcast, where we cover financial topics such as retirement planning, tax planning, portfolio management, insurance, and estate planning, so you too can have a wiser retirement. I'm your host, Casey Smith, guiding to financial success. Is my co-host Matthews Barnett today. Hey, Matthews.
How's it going?
Brad Lyons is serving his civic duty today.
Sounds fun.
On jury duty.
Hopefully it's just today.
I was thinking about that. It's like, what if he got the crime of the century?
A big case. He might be there a while.
He could be there for months. We may never see him ever again. I don't know. I don't know anybody who's ever been on a big case. Do you?
I don't. Hopefully it's not Brad.
That could be interesting. I know it would be digital crimes, because he doesn't know anything about technology.
I don't know. That might be the one he wants. But yeah, you never know.
That's true. I mean, don't you just have to stand up and say, like, they're all guilty, everybody's guilty, and then they won't pick you? I don't know the art of not getting on a case. I only had jury duty one time, and it was like, I was in my 30s, but I remember somebody close to my age had done something. Can't remember what it was, but they asked everyone to stand up, introduce themselves, and it must have been in my early 30s. But I remember standing up. I'm Casey Smith. I'm from Marietta, Georgia, and they go, "Okay, well, what career do you have?" It's like, "Well, I'm a financial advisor, but I'm also a commercial airline pilot." And I was pretty much the overachiever, and the person that was they're trying to pick a jury for was not that person.
So you got
I was gonna
kicked out of there pretty quick.
I was going to have no sympathy for this person whatsoever.
I guess it takes all kinds and who they're looking for, but
yeah,
it'll be interesting to see.
I figured that was going to be the case, so I kind of played that up a little bit. But I didn't get chosen. Although when you don't get chosen, sometimes you're just like, what? They didn't pick me? Why didn't they pick me?
I'd be perfectly fine with that.
All right. Well, today's topic is going to be focused on ESG investing, and we have covered this. I don't know directly, but it's popped up in so many different podcasts that we have and market newsletters. I remember when Larry Fink at BlackRock made his big statement about ESG investing, and then I feel like just kind of the whole world changed at that point. Well, we'll get into that, but let's first talk about what is ESG, because a lot of people probably know what that acronym means.
Yeah, well, it's kind of an offshoot of what originally came about, which was socially responsible investing, where you'd exclude certain ethical things like alcohol, tobacco, or firearms due to just personal preferences, right. And then that's kind of moved on to the ESG environment today that's become so popular, and you hear about is environmental, social, and governance. There's a lot of different criteria to each of them. So environmental explains how a business performs as a steward of a natural environment. So it includes things like categories of waste and pollution, resource depletion, greenhouse gas emission, deforestation, and climate change, which is probably one of the bigger things right now, is climate change. So that kind of goes into the wrapper of the environmental side of things, or the E part of it. And there's also social. So social is a little different. It's looking at how the company treats their people. Didn't used to be a big deal, but now that's kind of become an important part of corporate structure is social side of things and how you treat your employees. So they need to look at employee relations. Also diversity of the company as well as boards is huge now. Working conditions like child labor, local communities, making sure that they have other programs that fund projects in the communities and serve those that are underserved, not just locally, but globally. The health and safety of the company, and then how they resolve and deal with conflict. So that's what goes under the social wrapper of things. And then the G component of that is governance. And that explains how a corporation policies itself, how it's governed, and then how it focuses on various strategies like tax strategies, the executive structures, donations, and political lobbying, corruption and bribery, and then also the board diversity and the way that they're structured as well.
So therein lies the problem with ESG from the start is who's the judge if your company is doing great in the environmental, social, or governance category. We kind of default to MSCI, which is a well-known index provider, and they have ESG rankings. You can find those on ETF.com if you do like ETF.com / like VOO for Vanguard S&P 500, and you would see its MSCI ESG ranking in there.
Which is a newer thing.
Yeah, it's very new relative to all this.
Right.
There are other companies out there as well that have ESG rankings. I assume S&P does, but I don't know that for sure. It's not prevalent anyway, at least in what we the data that we get. So you know, it's one of those things where if a company has a high ESG ranking, then it's going to show up in other places. So like Microsoft pledged, Bill Gates through his own shares, I think to fund it, pledged to be carbon neutral by a certain date, right? That's a lot of servers using a lot of energy at Microsoft. So that's a very, very big task at hand to figure that out. Delta Airlines, another company, carbon neutral. Here they are burning holes in the sky.
Traveling worldwide.
Traveling worldwide. I was like, how many trees do they have to plant to make that be carbon neutral? Right.
And that there's not like they're changing, going to EV planes or anything. They're just planting trees to offset the carbon emissions. And that's kind of how that's considered.
There are electric planes now being tested, but nothing to hold 300 people.
Right.
I mean, it holds barely 1 or 2 people.
It'll be a while.
And it doesn't go very far. Yeah. And I don't know that I want my airplane powered by battery. I think that's
battery or solar can be an issue.
Yeah. Yeah, that would be an issue. Solar, maybe. But anyway, I digress on that. Not the whole engine, just solar to power other things, make it more efficient, I guess. So the other part too is and this will introduce Larry Fink. So Larry Fink is the president of BlackRock. BlackRock is known for their iShares ETFs, one of the first launches of ETFs in the country. Broadwise, State Street and their SPY was the first ETF in 1991, I believe.
Yeah, I think they're the largest asset manager in the world.
Yes, $10 trillion inside their investment portfolios altogether that they're controlling. So when you buy shares of a ETF or a mutual fund that they control, you don't get the voting rights for those individual companies. They do. So he's using this power to move forward, basically trying to solve climate change. So he's, and again, I assume most people don't know about his letter. He has an annual letter he writes every single year to CEOs across the world. It's probably followed almost as much as Warren Buffett's inside the industry. So every year he's writes these letters. For instance, in 2020 during the riots, racial riots, he demanded that corporations solve this. He wrote in, I believe it was, also in 2020. I'm sorry, in 2021 was the racial injustice of 2020, and then in 2020 he wrote he will be increasingly BlackRock will be increasingly deposed to vote against management and board directors when companies are not making sufficient progress on sustainability related to disclosures and the business practices and plans underlying them, unquote. Obviously that made headline news, and what people don't see on the backside is we follow BlackRock very closely for their advisor focused models. So they have many different models built. So if I wanted to go build a model for someone that was super tax efficient, I might go to them for that resource and say, hey, what do your models look like? Now I can just take that model off the shelf and use that with my client, or I can use that. What we do is we use it as a blueprint to say, okay, this is similar of what's working at $1 trillion company. How can we formulate that specifically for our client? And so we might change out the funds or make some alterations. So we were doing that at the time. And then all of a sudden overnight, they say, hey, we recommend trades in these models. And we were following those models at that time. And all of a sudden, all these ESG funds appear, which had been around, but not really prevalently used. So when they did that, there's people who, for whatever reason, don't think for themselves, and they just follow the leader.
Well, the biggest company in the world's doing it. It sounds like it's a good thing to do.
Right. And so I started looking at that going, that's not going to be for us. One, I'm very cost conscious when it comes to portfolios, because that's really one of the few things you can control in a portfolio is the cost of the portfolio. Two, the demographics of who works with us and where we live here in the South, we tend not to just follow the leader. We tend to be a little more free thinking at times. And I didn't think the client base was going to jump on the ESG bandwagon, even though they actually are on the ESG bandwagon, they just don't know it. Right. So it became a kind of a conflict for me in that, okay, we want to be responsible with our earth. We don't want to be throwing trash out into the street, and we don't want to be piling up landfills unnecessarily. But at the same time, I don't know that your portfolio is a place that you go to make that change. Right. We want everyone to be looked at based on their skill and them as a person and as a human being, not by the color of their skin or any other disqualifying factor, because that's how they were made. Right. But again, I'm not quite sure that your portfolio is where you go to fight that battle, because my theory was at the time that the world's moving this way. ESG is not something that I'm fighting against. It's not something that anybody's really fighting against. It's just happening. And what I see is now the world's largest company, asset manager, but not just them. I don't want to pick just on BlackRock. There's other people on this bandwagon too that are profiting from this.
Yeah. I mean, there's specific niche markets where that's all they do now.
So case in point, right? I referenced the MSCI ratings, and one of our largest holdings inside of our portfolio is the S&P 500. So when I go and look at the S&P 500, right now it has an MSCI ranking of AA. The scale, let me look that up. The scale goes from, let's see, triple C to B to double B to triple B to A to double A to triple A is the highest rating you can have. Somewhat like bonds. So a double A rating is the second highest rating you can have. The S&P 500 just a few months ago was rated A. So what we've seen over this last year is the S&P 500 has moved from an A rating to a double A rating all by itself. Now, the nearest apples to apples comparison is going to be a fund. Also, IVV is a BlackRock fund, is also a large cap fund. That large cap fund has a ticker of ESGU, which is the iShares ESG Aware MSCI USA ETF. It's the longest name ever. So this ESG fund is going to be made up of companies that have a high ESG ranking that are also large cap companies here in the United States. So that fund rating for MSCI ESG ratings is also AA. So the S&P 500, which is 500 companies, ESGU, which is made up of roughly 323 holdings. So they've eliminated a little over 180 companies, I guess, that didn't quite make the cut.
Didn't make the cut.
Which I find humorous because those companies are such a small percentage of the total S&P 500. S&P 500 is not equally weighted; it's weighted by market cap. So the bigger companies are going to be heavier, have a heavier
They
weighting.
should move the average. It makes sense.
Right. So the companies that they cut out at this point, I would argue, are insignificant anyway. So if we're looking at that now, the first thing I go to, and you shouldn't always screen funds this way, but in this comparison, I immediately went to, okay, how much money are they making on me? So the expense ratio of this fund is 0.15%. That's pretty low compared to fund fees over the last 20 years. But in today's world, that's actually a fairly higher fee, especially for a passive managed fund. It doesn't have a manager. It's not stock picking by an individual person. It's basically a computer that's tracking certain ratings, right, of companies to build it this way.
Yeah, I mean, that can still be 3 to 4 times what a lot of other funds are right now.
An example of that is the S&P 500. So the S&P 500 has a fee of 0.03%. Now, I don't expect anybody listening to do the math on this. I did it for you. We're a full service firm. The math is by moving you out of the S&P 500 into a similar fund. I mean, look at it this way before I get to the final answer. Let's just talk about the holdings. ESGU, largest holdings: Apple, Microsoft, Amazon, Tesla, and Alphabet. Largest holdings of the S&P 500 are Apple, Microsoft, Amazon, Alphabet, and Tesla. So that's slightly different order, but the percentages are almost the same. The only difference on the top 10 holdings, honestly, is ESGU has a little bit higher ranking with Home Depot and JP Morgan. That's the only difference. But those are right behind here. So those are the top 10 holdings, virtually identical. So by moving you out of S&P 500 into ESGU, BlackRock's making a little over $35.8 million more per year.
For a similar index.
Now, when you build a new index, there is a lot of back testing involved. BlackRock does it. Everybody does this. This is not a conspiracy theory at all. But when you build a new index, you're looking back at data and saying, oh, I think we found something unique here. So let's go build this new index and let's make it an ETF, right? And so whenever you're back testing all of your data, you want to be able to show the market, well, this strategy performs better. So when you launch a new ETF, it better be performing better, or else you're not going to get much new business, right? So that's how this started. So a lot of this started in 2020 or just prior to that. We start seeing ESGU perform better than the S&P 500. To this day, it's still maybe 2 percentage points better since inception. But what happens though, as the theme or as the theme fades away, we start seeing dispersion between the tracking on that versus just buying the S&P 500.
Yeah, I mean, you look at that, most of the performance was after those announcements and when that caught on, and then it's kind of leveled out since then.
So if you look at performance just over the last year, the S&P 500 returned 23%, 23.2%, and ESGU's performed at 19.9%. It started kind of falling apart in 2021 around March for whatever reason. It started separating in performance. Now, if you look at since all time, again, you're going to see many articles written that ESG outperforms just regular investing, and it's all over the internet. But again, there's a data bias, or there's a bias there in the data. There's not enough of it to begin with. I mean, if you want to tell me something performs better, you got to show me a 10-year chart history.
Yeah, you can cherry pick all the data you want. We were talking about before, really anything can be called ESG. We were looking at a clean energy fund that's technically considered ESG just because it's a clean energy fund. And so obviously over time periods in 2021 and significantly outperformed, but it's down over 30% over the last year, while other funds like S&P are up double digits. So huge dispersion there.
You know, they call that greenwashing. Like they'll say anything is related to ESG just to go, oh yeah, we'll buy that. I feel good doing it. And there's so much emotion involved in investing. I literally was watching a webinar. It was like a live event, and there was a lady who was buying ESG, and there's another gentleman adamantly against it. He's like, why would you ever do that? Like, it doesn't make any sense investment wise. And he had her pinned down on every single point as to why you should never buy ESG. And finally she defaulted to, it makes our clients feel better. that was the bottom line. What also makes our clients feel better if the market's falling and we liquidate everything. But it doesn't mean it's the right thing to do. It doesn't mean that you win in the end by taking that action. In fact, we adamantly fight against it, even though ourselves were going, God, I'm so tired of these markets falling, right?
Yeah.
But then there's the right action, and then there's what the data says. So just to be clear, us as a firm, we're not against necessarily ESG as a whole. People have kind of jumped onto this almost like a religion. They're so passionate about it. I mean, I look at my LinkedIn feed, and people that I know or have known high up at like Invesco and State Street and iShares, they're all out there touting, oh, ESG is the way of the future. They're proving my point. If ESG is the way of the future, then why wouldn't I just buy the S&P 500?
Everybody just mentioned it has their own proprietary funds and indexes, so it makes sense that they would be touting the profits moving that way. But like you said, nobody's against environmental, social, and governance. Those are great things to be accomplishing. It's the point of whether it actually is accomplishing that, and also whether it outperforms and makes sense to invest in that versus the other traditional indexes.
Well, that's a great point. If you buy an ESG fund, are you making a difference? I don't. If you buy, people seem to be disconnected from reality. If you buy Coke stock, how does Coke benefit from you buying Coke stock? It doesn't.
It'd be tough to quantify this right now.
It doesn't. You buy a company because you think they're going to make money and they're going to pay a dividend, or they're going to have earnings growth, right? And so you're profiting from that money, that company going up in value. By buying their Coke stock, you're getting the ability to vote on such proxies if you want to make a change. So potentially,
which 90% of people don't use anyways.
That's right. Well, yeah, that's true. Most people just throw those things in the trash simply because there's so many outstanding shares of Coke. You'd have to be a Larry Fink to be able to change board seats and change positions, or an activist investor and focus all your resources on one company.
Right.
And there are people who do that, and they're famous and they're activist investors, and they're trying to make a change. We don't represent those people. We represent everyday Americans who are working hard, who are putting their money into the stock market, looking for the long-term growth to be able to retire and live their best life. That's what we do. So why the heck would I take $35 million of their money and send it to BlackRock? Because we're passionate about ESG. It just doesn't make sense, because you're not making any change. You're just making wealthy people more wealthy. That's all you're doing. And you know what? He's a genius. He's a genius, because I believe that he actually is concerned about climate change. I do, but not that much. Because if you took money from him, he wouldn't be so concerned about it, right? So it's very self-serving, but it's genius. You don't waste a good crisis. And so he's looking at, okay, we have this climate change. We have millions and millions of people that are concerned about climate change. We're going to make money off of them. It's no different than Patagonia. Man, I love their products. But man, people drink the Kool-Aid there. They drink the Kool-Aid and they send out these radical emails about, preserving the national forest and preserving all these things. Like, I don't know anybody's actually trying to take it. Even the last administration wasn't even trying to take. They added to it technically.
They've got the base for it. Though. There
was an oil pipeline. I'll concede that. But the point is that even in this current administration, they're sending out the same emails, which tells me it's not about the forest. It's about making money, right?
It's a business.
It's a business. So yes, they make great products, and almost all my winter stuff is from them. And I love the fact that a lot of it's made here or made places that I know that it's not using slave labor and things of that nature, right? So, and I'll pay a little more for it because of it. But I read their emails. I'm like, yeah, I'm not your target market. But it's yeah. So going back to the ESG front, it comes down to making money off of people who don't know better. And that's one of our jobs as advisors. We have to be advocates to the people who just want to go enjoy their lives and not worry about if Larry Fink is trying to pull money out of their back pocket.
Yeah. I mean, like you said, that they've got something to sell. We're fiduciaries. If it were in their best interest, we would do it, but we just haven't felt that it is in clients' best interest right now.
No, but I know advisors that are building ESG model portfolios because they're trying to attract people who ESG is very important to them to have ESG. I think it's more important that they have money, because that's what's going to happen is you're going to start deviating. ESG is a fad. You're going to start deviating from the major indexes because the major indexes are more diversified than the ESG portfolio. Now, they aren't poor diversification. 300 something companies is still diversified. But we've only picked on the S&P 500. We can switch over to EFA, which is the Europe, Far East, and Australia. And it's a little better story there in that the ESG fund is actually matching the index in performance, but it still costs you more money.
Same cost, same percentage, basically.
Right. Yeah. So make another 35. Well, actually, that fund might be a little larger. I'd have to look at that. But as far as performance over the last year, it's actually outperformed by a very small percentage, 8.25 to 8.59. Again, that's just over 1 year. If you look year to date, they're neck and neck. The foreign stocks are down 3.63%, and the ESG version is down 3.8%. But we're only 30 something days into the trading year, so
it's been an interesting year already, regardless.
But you have to remember too that ESG as a concept didn't really start here in the U.S. It really started building more in Europe, because the ESG fund, foreign fund by BlackRock, is a AAA MSCI rating, and the EFA, which is the traditional foreign core holding, is ranked AAA also. They have the exact same ranking. So really, if you wanted to be very passionate about ESG, you probably have to find an active fund manager, like a traditional mutual fund, that is doing more activist type things. And I looked at a few of those. The performance was dismal, honestly.
What was the cost? 3 times that?
Cost is over 1% in a couple of cases. So you're going to pay for it, and your wallet's going to pay for it. But I don't see this is where you need to lead your crusade. If you believe in ESG and all that it stands for, every line item, you need to keep your money in the core asset classes. Go vote for politicians that believe in what mission you want to accomplish. Go protest, right? Go participate in
go volunteer, take your
volunteer,
time.
And I mean that's how you make a change. It's not going to be, it's not going to come from your portfolio, because quite honestly, the very people that you're honoring, promoting, like Larry Fink, are actually just extracting money out of your pocket into theirs, is what's really happening. So again, I go back to, I do believe that this is a fad. I've seen it with low vol. I've seen it with other things. This just happens to have a political component to it. that people are very passionate about. Some people might listen to this podcast and go, oh my gosh, this is ridiculous. But this is just data. And when it comes,
numbers speak for themselves.
When it comes to indexing, you have to remove politics from your portfolio. And we tell clients this all the time. I mean, for us, I feel like it started during the Clinton-Trump campaigns, because people came in and half our people would say, how do I Trump-proof my portfolio? And the next half would say, how do I Hillary-proof my portfolio? And the answer is exactly the same. Exactly the same. You own 6,700 companies inside 14 different index funds and 12,000 bonds. Okay, it's not about Trump versus Clinton. It's about capitalism versus not having capitalism. You need to make sure that America is still the place where you come to create companies, grow companies, hire people, right? As long as we're the place that people are coming with their startups, that still today is as bad as people say, oh, America's in such bad shape. We're still the spot where people come to create their businesses,
create jobs, and invest in America. The domestic, as you see the S&P, it's a great place to invest in the U.S.
So as long as we're the place to do that, then an index portfolio is not going to care who the president of the United States is. And some people get really angry, and I say, well, I don't get angry. They probably get frustrated and say, well, what you need is a Democratic president and a Republican-controlled House and Senate, because those are the years you make the most money historically in the stock market, right? Because they're forced to work together to move their agenda, and the agenda is a little more
usually harder to get things accomplished too.
Yeah, it's harder for anyone to go to their extremes. So in that scenario, you're going to have the best stock performance historically. There obviously were other things going on in the economy at the time. It's not just because of that, obviously, but it's you got to remove the politics. You got to remove that from your portfolio. You have to remember that, we talk about how great ETFs are, but there's companies behind the creation of these ETFs and mutual funds. And you have to understand what their agenda is. They are marketing to your fears. They're marketing to, because fear motivates people to move.
Probably one of the biggest motivators.
They're marketing to the headlines in the paper, and they're trying to sell you something. And what you have to make sure is what you're purchasing in your best interest. And that's the hardest thing for people to figure out. That's how annuity sales are sold. What you told me many years ago, or a few years ago when you started with us, annuities are sold, they're never bought.
Yeah, it's true though. It's sell the fear, and actually, whether it's understanding the ins and outs of annuities, insurance, or just underlying ETFs or other products, you just got to do the research and really understand, what the reasoning is behind you purchasing those things.
So my prediction is ESG funds fade away. I don't know what the timeline is. It might be 4 or 5 years, because if the entire world, and let's just, or the U.S. is moving toward ESG qualities, then that means the S&P 500 ends up being, and big cap and small cap, they end up being the ESG leaders, right? So why do you need to pay someone more money? I don't know. I don't get it.
Sounds good. We'll find out.
I guess it sounds good. We don't get paid to tell people what sounds good. We get paid to tell people the truth. And that comes from, not just financial planning, but in building portfolios. And quite honestly, I haven't had the only questions I've had about ESG from clients is this something I need to worry about, or something I should be concerned with? Like, do I need to buy these funds because they're better? The basis of the question is, where's the performance? How do I make more money? It's not activism, right?
And that's what you see the most of, whether it's either fear or just in the headlines, is ESG is very prominent and popular thing these days.
And that could be because of where we live. Being in the South, we tend to not gravitate toward such causes as much as maybe Northwest or the Western states. But this shouldn't matter. In the end, independent advisors who are fiduciaries have the same obligation. And so, I don't know. It'd be interesting to see if there's any liability for them out in the future. Who knows?
We'll see.
All right, Matthews.
Enjoyed it. Thank you.
Enjoyed it. Talk to you later.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. Wiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.